Let me say something that might surprise a lot of people watching this. The BRRRR strategy, the famous real estate investing strategy that everyone on YouTube talks about, is failing for a lot of investors right now. Now, before people jump into the comments and start yelling at me, let me be clear about something. The BRRRR strategy still works, but the version of BRRRR that everybody is teaching on the internet, that version is getting a lot of investors into a serious trouble. And the reason is simple. Most of the advice you hear online is based on a market that doesn't exist anymore. Interest rates are higher, construction costs are higher, appraisals are tighter, and rents are not climbing like they used to. So today, I want to break down what's really happening with BRRRR in 2026, why so many deals are falling apart, and what smart investors are doing differently right now. And I'm not speaking from theory here. I've been in real estate since the 80s. I've owned single-family homes, duplexes, multifamily, flipped houses, held rentals. I've seen multiple cycles, and every time the market changes, the strategies have to change with it. If you try to use yesterday's strategy in today's market, you can lose a lot of money. So let's start with the basics. For anyone new to real estate investing, BRRRR stands for buy, rehab, rent, refinance, repeat. The idea is simple. You buy a property below market value, you fix it up, you rent it out, then you refinance the property and pull money back out. Then you use that money to buy the next property. In theory, if you do this correctly, you can build a rental portfolio without leaving a lot of cash stuck in each deal. That's why so many investors love this strategy. You hear people say things like, I recycle my money. I pull all my cash out. I own 10 rentals and none of my own money is in them. And during certain markets, that absolutely worked. But here's the reality. The environment that made BRRRR easy has changed dramatically. Let's talk about the first big problem. For years, investors were refinancing their properties at 3% or 4% interest rates. That made the numbers work beautifully. So let's say you bought a property, fixed it up, and refinanced. Even if the property value went up modestly, the payment stayed manageable because interest rates are so low. But now, mortgage rates for investment properties are 6%, 7%, or even higher. And that completely changes the math. Now, when investors refinance a property, the payment can jump dramatically. What used to be a comfortable cash flowing property suddenly becomes a property that barely breaks even, or worse, loses money every month. And here's something many new investors don't realize. When interest rates go up, property values don't rise as fast. Not only are investors getting higher payments, they're also getting lower appraisals. And that leads to the second major problem. During the hot markets a few years ago, something incredibly was happening. Investors would buy a property, put money into repairs, and their value would jump dramatically. Sometimes an investor would buy a property for $150,000, put $30,000 into it, and suddenly it would appraise for $250,000. That kind of jump made BRRRR deals look magical because when you refinance at 75% of that new value, you could pull almost all your money back out. But that's not happening nearly as often anymore. Appraisals are being much more conservative now. Lenders are being more cautious, and in many markets, property values have leveled off instead of skyrocketing. So investors finish their rehab, apply for the refinance, and then the appraisal comes in lower than expected. Suddenly, the refinance doesn't return their money. Instead of getting their cash back, they're getting stuck with $30,000, $40,000, sometimes $60,000 locked inside the property. That doesn't mean the deal is bad, but it does mean the repeat of part of the BRRRR becomes a lot slower. And that's where many investors start running into trouble. The third problem with BRRRR right now is the cost of repairs. Construction costs went through the roof over the past few years. Materials went up, labor went up, contractor schedules got longer. A rehab that used to cost $25,000 might now cost $40,000 or even $50,000. And if you underestimate those costs, your profit disappears quickly. I've seen investors buy a property thinking they're getting a great deal, only to discover the rehab budget was way off. What started out as a $30,000 renovation becomes $60,000. Now, the refinance numbers no longer work. Instead of recycling their money, they're forced to leave a huge amount of cash in the property. Again, the property might still be a decent rental, but the strategy they plan on using doesn't work the way they expected. Another issue investors are running into right now is rent growth. For a while, rents were rising extremely fast in many markets. That helped BRRRR deals work because higher rents meant higher property values and stronger cash flow. But in many areas, increases have slowed down significantly. So markets have even seen rents flatten or drop slightly. So now investors are dealing with higher purchase prices, higher renovation costs, higher interest rates, but rents that aren't rising enough to offset those costs. And that squeezes the deal from every direction. Now we get into what I think is the biggest hidden risk with the BRRRR strategy, the refinance. Everything in the BRRRR model depends on that refinance working exactly the way you planned. But the refinance is something you don't fully control. The lender controls it. The appraiser influences it. The interest rates affect it. And the market conditions determine the final value. So when investors structure a deal assuming they'll pull all their money back out, they're taking a big risk. If the refinance falls short, they can get stuck with a property that ties up their capital for years. Now again, that doesn't mean the deal is bad, but it means the strategy didn't perform the way they expected. And that's a big difference. Here's the truth most people won't tell you. BRRRR deals don't fail because of the strategy. They fail because investors overpay on the purchase. Everything in real estate investing comes down to one thing. You make your money when you buy. If you buy the property right, the numbers can still work even when the market changes. But if you buy too high, no strategy can save you. You can rehab perfectly, you can rent the property quickly, but if you pay too much at the beginning, the refinance will expose that mistake. And that's exactly what's happening to many investors right now. So, does this mean investors should abandon the BRRRR strategy? Not at all. But smart investors are adjusting the way they approach deals. First, they're buying deeper discounts. Instead of looking for small deals with tight margins, you're focusing on properties where the numbers make sense even with conservative assumptions. Second, they're planning for lower appraisals. Instead of assuming big value jump, they run the numbers based on realistic expectations. If the appraisal comes in higher, that's great, but they don't rely on it. Third, they're focusing heavily on cash flow. A property should make sense as a rental, even if the refinance doesn't return all their cash. Because if the property produces solid income, time will eventually solve the rest. Real estate is a long-term game. One thing I've learned after decades in real estate is this. There are always new strategies that get popular. At one time it was flipping, then wholesaling, then Airbnb, then BRRRR. Every cycle creates a strategy that looks like the easy path to wealth. But the fundamentals never change. Buy right, manage your expenses, hold good properties long term. That's what builds wealth in real estate. Not flashy strategies, not internet formulas, just solid deals over time. The BRRRR strategy isn't dead, but it's definitely harder than it used to be. Higher interest rates, more cautious appraisals, expensive renovations, slower rent growth. All of those things make investors rely on something that has always been true. You have to buy the property at the right price. If you do that, the numbers usually work out. If you don't, the refinance will eventually show you the mistake. And that's the real lesson here. BRRRR still works, but only when the deal is strong from the beginning. If you found this helpful, make sure you subscribe to the channel. I've been in real estate for over 4 decades. And on this channel, I share the real strategies that actually work, not the hype you see all over the internet. And if you're building a rental portfolio thinking about getting started, drop a comment below. I read every one of them. Thanks for watching, and I'll see you in the next video.